InvestSMART Separately Managed Account Benefit number 4. Growing your savings. Our SMAs have a monthly saving plan starting as low as $100. Combine this with the dividend reinvestment plan and the power of compounding returns, you've put yourself on the right path to achieving your savings and investment goals. For more information or to start a free trial, visit investsmart.com.au.
Hi, I'm Daquino and I'm a journalist at Eureka Report. Welcome to Market Watch. Trading volumes have been light as of late as investors tiptoe around a market which has lost quite a bit of steam from the start of the year to now. At the top end of the town, the ASX 20 index was down nearly 5% from the start of May to the end, nearly doubling the ASX 200's more palatable 2.7% loss. As we can see here, the ASX 200 has really tried breaking out on its own since the start of May. But obviously, it can never have a stellar solo career of its own. The big four banks have a combined weighting of between 25 to 30% of the ASX 200, and right now, they're a real drag. In the year to date, we can see the benchmark Australian index peaked on May 1. Since then, it's been coming down. The banks are definitely keeping our attention, but no matter what tricks they pull, they just can't seem to please the crowds or connect with investors at the moment. They paid out their half-yearly dividends, reported around $15 billion in profits, and were still dumped by investors. They lost between 10 and 16% of their share prices during the month of May. Our 5 largest financial institutions were targeted in Treasurer Scott Morrison's federal budget at the start of May, which slapped them with a new levy to raise an earmarked $1.5 to $1.6 billion. But in the end, the banks determined it would cost them well shy of this, around $1 billion on an aggregated basis. A short time ago, the big bank's loss was the little bank's gain. Naturally, it hasn't exactly stayed that way. Small bank shares slipped on ratings agency Standard & Poor's last week, cutting 23 domestic lenders' ratings due to an increased risk of property prices sharply correcting. AMP, Bank of Queensland, Bendigo and Adelaide Bank were among S&P's victims. Shares have been shaky since. The banks have been the bedrock of the ASX since the market bottomed in June last year, which raises the importance of any development in the space. There's a whole set of reasons and speculations the local market year to date has been sluggish, or anemic as many analysts call it. Investors are concerned about high valuations and a narrative-changing government, which now appears anti the banks. Overseas, we're seeing a shrinkage in the amount of stocks, keeping US markets at all-time highs. Is it the broker's fault? No, of course not, but the number of upgrades to downgrades issued by brokers for the month of May is certainly out of whack. It's not the broker's job to keep the swing set stable, but to keep an eye on the entire ballpark. Among the investment banks covering Australian equities, there were 70 downgrades versus 16 upgrades for the month of May. So are we back to slow to no growth in our large caps? As Eureka Report commentator Bob Gottliebson said in his latest column, referring to BHP, it is not fashionable to call yourself a growth stock in the ASX 20 in this environment. We are in a low credit growth environment, and analysts caution it could only take a little for tailwinds to come alive. There's been enough talk on house prices. The banks, retailers, shopping centre operators, health insurers, car dealers, the list goes on. It seems everywhere you look to find a bit of treasure, there's an expert telling you it's no longer there. Or if it is, it isn't even worth the note discussing it is printed on. Maybe you just have to look a little bit harder for value.